The SharePickers Podcast.
And joining me on the podcast right now, and of course, live in Technicolor, we will be looking at some charts. So, check out the video. Alan Green, CEO of Brand Communications. Sure, Al?
I'm good, Joss. How are you?
I'm all right, It's almost like, when is the rain going to stop? Even this morning, it was raining again. Oh, for heaven's sake, stop the rain.
Well, actually, I took the opportunity to get out earlier on this morning and spread some fertilizer on my grass because I thought, well,
It's a practical thing.
Yeah. We have to do it. You see, we've got new bits of grass. It's all blending in nicely. So I thought, well, now's the time. You've got to put it out in March. So it's going to chuck it down tomorrow. I know that, but I think my weather app's got 89% chance of rain, which means it'll definitely chuck it down all day. So, you get the fertilizer down before the rain, down comes the rain, soaks it all in, then the sun comes out, grass goes mad. So that's the theory.
Yeah, and
it has worked in previous years.
Yeah, well, you say that you took the opportunity this morning to get some fertilizer down. Are you saying also saving money on flushing toilets, aren't you? Because if you go outside and doing that yourself, then...
No, I think...
you have to go early while the neighbour's not up.
I think you're thinking of obscure villages in China, somewhere in China, where they actually use human excrement and human waste to actually fertilise the fields. But I haven't got.
So what you don't want is a neighbour to catch you doing that. So you have to do it very early in the morning.
You have to get out there early, before.
Oh, look, Alan again outside. Yeah. Look at him. What is he? Oh no! Oh no! Why are we living next to this lot? Right. Okay. Yeah. Let's talk some stocks then. What's on your list today?
Okay, so following on from last week, we're looking for quality companies that have delivered in the past, operate in a niche sector in the market. So I've got two of those for you, but I've also got a stock which has been restructured on Aquis, and I think offers a fantastic opportunity. So firstly, we're going to talk about Trifast. TRI is the EPIC code. It's a company that's based just up the road from me, actually, in Uckfield, in East Grinstead. And this company, long history, lots of success. The company's it manufactures fasteners. So if you go on the website, and you look at the products, you'll see lots of little washers, lots of little nuts, little bits of little connectors, all the rest of it. So if you walked into B&Q or if you walked into Halfords, for instance, you have all these little packages. So you want to sort of fix the electrics in your car or do some new stuff. And this is what this company does. What they've done over the years, they've acquired a series of businesses to the point where they are now, they're now pretty much global. They operate in over 70 countries. Exactly. So there are the products you can see on the screen there.
Screws and bolts, nuts, washers, circlips, rings, seals, O-rings, fasteners, machine metal. They've got all of it there.
Well, they have, and they do those little trays. And me doing what I do in my spare time, I restore old classic motorbikes. And of course, I've got trays of these nuts and bolts on the garage because they're great. You can replace old fasteners with new ones if you're restoring an engine, and you get that engine looking good again. So it's a huge market. I mean, the company has done sort of great work over the years. If we look at the, I'm just going to find my. I'm just going to reduce this a bit, actually, and I'm going to go to the most recent update from the group. Now, this took place on the 22nd of January. The company has had a difficult time, and obviously you can see, looking at the chart, that it's reflected in that. So they generated lower than expected volumes from the Asian businesses, and they anticipated seeing a recovery from the subdued first half. That's not yet happened, so they expect the challenging conditions to persist. But what they've actually done, they've actually undertaken a restructuring program, cut operating costs by some 10%. They've also cut back non-operational staff around the world, which will deliver annualized savings of about 3 million. So they're going to have a leaner organizational structure. But I like the business because this is a business that is cash generative, and obviously they've had issues, they've had difficulties, but it just generates steady turnover and steady cash generation. and this is the important thing. And I think if we look at the chart, we've seen that big fall at the start of the year, and of course that fall took place on the day of the trading statement. The shares have climbed up to 93p. They fell back, and we've seen a year low. We saw a year low, in fact, back in November last year of 66p on the year, and we're still above that low, which is encouraging. So I would expect if trading starts to improve and the cuts undertaken by the company start to impact on the bottom line, I would expect to see that share price start to creep back up again. But it's a good cash generative company. It does pay dividend yield of 2.9%, so not a big dividend generator, but nonetheless, if you're investing in this company, it's and you get in at the right time, then you could see a successful year in terms of capital gain, and also, of course, you'd be earning that small 3% dividend from the company as well.
Well, look at that. Since the half year to September, top line obviously dipped a little bit from 120 million to 117. Gross profit was better, so gross margin was better there. And if you scroll down, it's all going well until you get financing costs. I've seen they've gone up a bit, so I assume they've borrowed a bit more. Because they've gone from 749,000 to 2.7 or 2.8 million. So let's look at the balance sheet here.
And that's what they're impacting or moving to impact on now with this 3 million saving. But it's obviously going to take a while to actually filter down to the bottom line.
Yeah. Okay. All right. Yeah. But nevertheless, cash and equivalents at the end of the period, 32 million. So there are 99 million market cap, and they're sub 100 million.
Yeah.
And they got cash of 32. So
yeah. So this business is a big cash generator. Always has been, and it's had a, I wouldn't say checkered trading history, but it certainly delivered results in the past. But it's in a niche market. It's in a market where they have huge supply contracts, and also lots of retail sales as well, through outlets like Halfords or B&Q or whatever. So there's plenty of cash being generated by the company. It's always got that ability. So it's relatively easy for a CEO and an FD to undertake a restructuring program if, for whatever reason, there's a hitch in sales. So
do you know what? Look, they've repaid the borrowings. That's where the problem. So 98 million. So they got they literally no debt now. Oh no, they got 59 other interest-bearing loans, and this is long-term. About 60 million there, but nevertheless, net assets are 131. So they're below their market cap. So I always say, if you've got a company that's doing okay, generating cash, and they're below net assets, it's worth a look, because of course those assets will grow over time. They're generating cash and all that stuff, and so okay, all right, it's one of the watchlists. I like that. Yes. Okay, Trifast. It's one of those companies that's very boring. I mean, of course, in manufacturing, gross margin not very huge, but boring is often the way. If you've got a boring, stable business, that's what you want, isn't it? So,
well, this is it.
They are. Where are they at? So almost like a multi-year low there.
Yeah, well, if you look at the chart there, it's really come off those highs, and you've seen this gradual, fall in the share price. But it is a cash generator, and the balance sheet sort of illustrates that very well, and they're able to pay this debt down. So when you're generating cash like that, you might hit a challenging trading period, or one of your outlets doesn't perform, but you can, because you're generating cash, you've got that opportunity to restructure, and if you need to borrow, you can probably borrow at favourable rates and then get it paid back fairly sharply. So, and I always remember years ago, David Paul, God rest his soul, from Vectorvest, he was a big fan of this company simply for that reason. He said, it's a boring company, but it's a cash generator, and it'll carry on paying this little dividend. So you've got a little 3% dividend, and if you catch it at the right time, I mean, it's not inconceivable that we could see a big surge and recovery, as the global economy starts to recover. Yeah.
Okay. Well, I'll put through my StockScores list and see what the points are, what it comes up with it ranks in my top 100 microcap stocks. Okay. In fact, this is my list here. This is alphabetical order. 100 stocks valued ranked by growth, value, health, efficiency, momentum, potential, and we're looking at that. In fact, looking at we'll talk about Aquis again, but they did release full year results. And you can see here, growth is okay. It should be in green for the growth, really. But they were 106 million market cap. growth is okay, health is fine, and value is not that good. So if you scroll down, you're like 4.5 times sales, P of 20, price to book. So it's not cheap. But it's a good little business though. But it did spike up a little bit. But the average broker target from the brokers are 150% up. So their target is 967 from 386. I think how are they getting that? That's amazing, because they are literally talking about 10 times sales almost. That's not cheap. So I'm always worried about companies that are valued that highly, because you're thinking, well, if they go wrong, if they miss estimates, they're going to take a big fall. But nevertheless, so the chart last week after they announced news did spike up a little bit, and it spiked above that 200-day moving average, which I think it's coming a long way.
Operating an exchange like Aquis is a challenge at the best of times, but I think we've seen so many iterations of Aquis over the years. Of course, we had the OFX market, then we had ISDX, we had Next Exchange. And obviously we then morphed into Aquis. But I think the actual structure of the business now lends itself to growth far better because it's operating across this pan-European market. A lot of the stocks are dual listed, and its opportunities to make or generate profits are better than they've ever been. And I think Aquis is emerging as the exchange or the exchange of choice for companies coming to market, wanting to raise money, but without the budget to say, list on the AIM market or even take a standard listing with a £30 million market cap minimum. So Aquis is the venue of choice in that regard. And I think as we see the economy recover, as we see interest rates start to fall and inflation start to fall as well, I think Aquis will continue to benefit from that backdrop.
Yeah, but I mean, to be fair, in a tough environment, they've still improved. I mean, it's not a huge improvement.
Yeah.
I mean, look at the top line from 19 million to 23. Operating profits gone up from 5.8 to 6.2. Even profit after tax gone from 4.6 to 5.2. So the metrics are still improving, even in this tough environment for Aquis. But nevertheless, it is valued quite highly. But because it's a data platform, the broker suggest should be valued even more highly. So I'm just thinking, high valuations are always a risk, as well as because if they don't achieve the growth, then there's a big drop off. But okay, what's next, Al?
Okay, so another growth stock, again a favourite we've discussed sort of many times over the years. This is Team17 Group. TM17 is the EPI code.
Well, yes, in fact, Debbie Bestwick, who's I think was a long-standing CEO there, and one of the founders, wasn't she? I think, me.
She was the founder.
She recently, I forgot. I approached her on LinkedIn, and I can't remember when, but she recently accepted. So I don't know how often she goes on LinkedIn, but now we're connections on LinkedIn. But there we are.
Well, probably beforehand, just she didn't have the time to respond to mere mortals such as you and I. But she of course stepped down as chief executive. I mean, Debbie was the founder. She grafted night and day to build this company up. It's a real British success story. The company's done incredibly well. Currently got a market capitalization of 336 million. Shares are trading at £2.26 or 226 pence. Year high of £4.50 or 450p. Year low of 145. Starting to recover off that big drop off last year, and that big drop off last year was really from a profit warning. But the company said at that point that there were certain titles within its games label that weren't meeting internal expectations. But since the first half results, they had to undertake a re-evaluation and a restructuring, and of course they then made provisions for impairments on the year of up to 11.5 million. So the full year EBITDA of 28.5 million was cited at that point, and indeed there was a further trading update at the end of January from the new chief executive, Steve Bell. Steve, of course, joined the business in September last year, formally took over as group chief executive. And he just said overall the group are very pleased with how full year trading for 2023 had closed out. Positive momentum across the portfolio, and very exciting prospects. And I think that's starting to reflect now in the share price. And of course, Team17 was renowned as a manufacturer and provider of games and and indie games, and it was the partner of choice and worked alongside indie developers to help them develop the game, and then of course became the marketing channel for them, and that's something that Debbie and her team generated huge success from. But the investment proposition has evolved since then. They now have their own games entertainment label, remaining that creative partner for indie developers. But they also now develop educational apps, and they have apps for children under the age of 8, and also a working simulation games developer and publisher. So it allows, if you like, developers to trial and test their games out. So it's a really good business model, and I think Steve has come in at a good time. Debbie, of course, remains on the board as a non-exec director, but again, this company has delivered stellar returns for investors over the years. Trades on a PE ratio of 16.8, which isn't really too racy, I don't think, for the sector. But if you look at the share price performance, we've seen a drop off, I think, since 2022. But certainly when we first started,
COVID was a boom, wasn't it, for games developers? A lot of people just sitting at home playing games.
Absolutely huge. I mean, 200p all the way up to I think 5-10 year high.
£9 there.
£9 a share. That's it. And I think we were talking about it sort of during that time, during that growth period. But of course, it's evolved and it's changed since then. So I guess now I'm asking the question. Looking at that 5-year chart, we're now seeing the stock has returned really to those levels that it was trading at. Is that, are we looking at a second opportunity? Are we looking at a second growth phase for the company under the new CEO? The company's evolved because it's had to. It can't be that indie developer anymore. It's now got other strings to its bow, as it were. So are we going to see a new phase of development for Team17? And I think, given the success the company's had in the past, the team of people that are working there and helping to build this company, I think few would bet against them. And I'd argue that now is a good entry point.
Yeah, it needs to it's had a couple of sort of technical breaks. It's oversold, it's bounced on the 200-day, gap down in the trading update there, gap down again. Hit a low down here, 148. It's rallied again on technical bounce. It keeps having these lower highs. But I would suggest maybe now, because that was a sort of a bounce here, maybe we are close to a low, because what is it? 22 days, I think the results are out. They got some results out.
Yeah, that's right.
And just looking on the thing, so
and the trading update sort of again reiterated 28.5 million EBITDA. So they'll come in with that. I've absolutely no doubt about that whatsoever. So I think once the numbers are in, and the analysts can study those numbers and just confirm the company's performing, then I think we could be looking at a breakout point. And obviously we'll be looking for some early indications of how the current year is going.
Yeah, well, average broker target's 313 at the moment, because of course it's a bit subdued there. But market cap, like I said, 3 million. Good, nice enterprise value, always below market cap, means we've got no more cash than debt. But so operating profit 32 million last year, so cash of 50 million.
Yeah,
which is nice. Enterprise value 280. Like I say, growth is there. It's got 52% last year. Operating profit not as good, but value PE of 14 is fine. EBITDA 5 right now. So it seems decent value here. Efficiency. Look at the margins here. Gross margin 50, operating 23%. That's good. Return on capital employed above 10 is nice. The only thing, the problem is momentum. Like I said, the share price is not above 50, 200, or the golden cross hasn't happened. So it's a decent company. I think it'll bounce back. But
I think looking
at the results at the way first, I think.
Yeah, as you say, results out of the way. But I think the results, if they confirm what analysts will be looking for, then I'm sure we'll see that golden cross take place, because the gaps are closing, aren't they? And I think we are seeing a bottom forming here, and I think that should be the catalyst that the share price needs to start to move high.
Marvellous. What else, Al?
Okay, so different stock this time. This is a company called TruSpine. The website just is TruSpine, TRUSPINE.org. So if you go there.
Yes.
And then if we go to...
This is Aquis, isn't it? I can't get
This is Aquis, yeah. No. So go to spinal fixation devices, okay?
Oh, bloody.
Okay.
Oh my word!
Yes, so
That's painful to look at. Survey lock.
this is a multi-billion-dollar industry, and everyone, I've had issues with my back. Everyone has an issue with their back at some point. So this is a company that has really had a challenging year, I would say, the past year. The company has faced challenges from the US in that the guy that invented the devices such as SurveyLock, such as Grasp and FasciLock, has basically sued TruSpine or told TruSpine that it doesn't own the IP. The company irrefutably owns the IP. That was established by Chief Executive Lawrence Strauss. But because the share price had come down so far, I mean, we're currently trading at just below a penny. The shares have been as high as, well, an awful lot higher than that. But the company has just undergone a major restructuring, and fund manager Jeff Miller has come into the company as chairman. And the week before last, the company raised 136 million and a total of 270 million plus additional monies to come in, which will. I'm just
130 million. You mean 130 rand?
136,000. It's
raised 136 million. Wow, that's good going.
It's raised 290,000 through the issue of just under 20 million new shares at a price of 1.5p. It's also through Jeff Miller through Jeff Miller's company going to be raising a further 136,000. And it has approved an unsecured convertible loan note to the value of 1.5 million. It's also entered into warrant surrender deeds with historical warrant holders for 16 million warrants, which are out there in the market, some up to as high as 7p. So those have now all gone. Jeff has brought with him two non-exec directors. One non-exec director, Victoria Senna, formerly worked for the Bank of England. She's got a risk management background, and they are going to work with existing management to help develop the TruSpine offering, in particular SurveyLock, which is currently with the US FDA awaiting approval. Provided that goes through, and they're some way down the road with that process now, then the sales will commence in the US, and there's a team in place all ready to do that. They have partners that they'll be working with. But this is a hugely exciting development because effectively it's brought £2 million into the company. The company currently has, if you look at the Aquis website and look at the share price, it currently has a market capitalization of 1.1 million. So it's not even reflective of the total cash that the company the new management team can bring into the company. So this is it's a pivotal moment for the group. Of course, once that FDA approval comes through, they can start marketing SurveyLock, generating sales from that, and then they can expand the business. And Jeff has a background in biotech and life sciences, and I'm sure they're going to be developing the company going forward. But it's a pivotal turning point, for the group, and I think it's. Investors might feel it's speculative at this stage, but when a chairman comes in like that, puts a lot of his own money and also puts a lot of his own family office money in, per se, that to me is a very good sign indeed.
Yeah, like I say, FDA approval, that's, and all that, it's really tough. I mean, assuming Polarian was going to get a slam dunk FDA approval, and they got knocked back. And so you never know what's going on with FDA. To me, it's a black box, FDA. You never know. I mean, because Polarian, I think it was like 95% chance. They did phase 3s. Two phase 3 trials, passed with flying colours, submitted to FDA, and FDA knocked it back, and the share price crashed. So I'd wait until that happens at least. But of course, pre-revenue stocks are quite risky. Say loss making, but interesting story. And like I said, the back problems. I'm getting back problems all the time.
Yeah,
the computer. I'm
it's
sitting at the computer watching TV sometimes, just looking down at my laptop. My neck and my back is not aligned properly. I need to get a proper sort of. I can't just put that in the living room. Proper sitting there on the carpet. Proper sort of office chair I need in the living room, because I always got my laptop out looking at stocks and shares, and so my posture is really bad.
Yeah, that's the thing. I think there's a generation now of, I say generation, several generations of people who are sitting on their laptops or on their tablets and trying to do three things at once: watch TV at the same time, maybe have a sandwich and work on the laptop. And yeah, from a posture standpoint, it's not good at all. But I think the solutions here are for people with moderate to severe spinal problems, but I think the technology is revolutionary, and it's been recognised by a large number of investors, and particularly the company that one of the companies that's behind the restructuring are very much engaged with that process, and I think we're going to see more institutional support for this company as it evolves and as we get further news on that FDA application.
So what did you say about the litigation thing? Is that over or not?
It's over. Yeah, it's gone.
Oh, okay.
The company last year, there were so many US investors that were backing the CEO, and it went. The lawyers got involved, and they have proved beyond any shadow of a doubt that the IP belongs 100% to TruSpine, and therefore, if the founder wants to do anything, he's got to work with TruSpine rather than against them. And I can tell you, certainly from a company level and from a personal level, I was getting a lot of let's just say messages from supporters of the founder last year, and all of a sudden, since the announcement was made that the IP was absolutely confirmed as belonging to TruSpine, they've all gone very quiet. So they've obviously done their homework and realised. So and then you've got Jeff Miller and the team coming in. That says to me that Jeff Miller is a very savvy fund manager. He's been around the block a few times. He won't be making those sort of moves and putting that sort of money in if he's not pretty certain of the outcome.
So you've got 7.24% now in the company by the looks of it.
Yeah, that's right. We TR1 this morning, 7.24% of the company, and that will rise, of course, once the other monies come in. So direct and indirect being through his family company, Afafa Limited, which is also an investor into TruSpine.
Okay, TruSpine, yeah. Jeff Miller, there we are. It's got there. Yeah. So he's got 6.8% of that. Okay, marvelous stuff. Well, listen, do your own research. Everyone, put you back into it, and put
you back into it.
Yeah, exactly. And everything on this podcast or video is not investment advice. Shouldn't be considered investment advice. It's just ideas. Some ideas are good, some ideas are bad. Please do your own research and take responsibility for your own money. It's your money, nobody else's.
BYOR.
Yeah, exactly. Marvelous stuff. Thanks for Al. Speak next weeky.
Cheers, just speak next weeky. Oh, it's Easter next week.
Okay.
Hey, 4 days off. Yes.
The SharePickers Podcast with Justin Waite. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.